Hey guys, so Steve and I wanted to do our quarterly hometown mortgage update and just give y'all an update on the market, give y'all an update on interest rates, where we think we're headed. And Steve's going to kick it off by talking a little bit about what's been happening in the economy a little bit.
So what we've been seeing and feeling and hearing for the last couple years, maybe, year and a half, everybody's been thinking we're going into a recession. Well, I think that's gone now. Nobody's talking about recession. And then also for the last year, everybody's been worried about the election and, how's that going to work out? And I know a lot of people stayed up late to see the election because they had one side of the fence they were on or the other. Well, now that's gone. So psychologically, people are starting to feel a little bit relieved, like, okay, we're not going into a recession, and now we kind of have the election done. So what we're finding is our phone's starting to ring again. And so we're seeing people starting to get interested again and wanting to get back out and look because they're not scared. So those clouds are removed. It looks like the market's going to start moving forward again a little bit.
Yeah, and so to go off that, I think, after the election is finished, a lot of people are curious about interest rates and what's happening with interest rates. Well, the big thing to note here is that a lot of people get confused when the Fed cuts their rates, but the mortgage rates actually go up, right?
They went up a point.
People get really confused by that, and it's super crucial to know that the Federal Reserve interest rate and the mortgage interest rates are two different interest rates. Now, those things play off of each other, but sometimes when the Fed reduces their rate, that actually could indicate the mortgage rates would go up. Sometimes the Fed reduces their rate, and that means mortgage rates go down. The mortgage rates are much more closely tied to the 10-year Treasury than they are the Federal Reserve interest rate. So if you're curious about where mortgage rates are tracking, the 10-year would be a good place to track. But all that being said, the Fed made a 50 basis point cut prior to the election. After the election, they made a 25 basis point cut. And mortgage rates are still hovering in the high sixes and the low sevens, depending on what your credit score and down payment and all that looks like. So we're still kind of in a little bit of a higher interest rate market. But where do you think it's headed?
I think we're going to be right here for a while, and the reason is that the bond market is saying, hey, we think that this is a pro-business, pro-growth sort of president. We think that the economy is going to start kicking off a little bit. We think these tariffs are going to cost more money to buy goods. So they see this, right now they're seeing the Trump presidency as more inflationary. And so the rates are staying high. They don't think, they're not seeing any reason to bring them down right now until we get a little bit further into administration. So I think we got to buckle down and say, hey, we're going to be around 7% interest rates for at least the next 3 or 4 months. Mm-hmm. And then we'll start seeing what's going to happen. We're back to that old saying that, you got to, marry the house and date the rate. Yep. I went back and looked at the last 20 years, and rates have kind of averaged around 6.5%. So we're kind of in that range, and we can still get people a rate in the sixes if they want it. You just got to basically buy the rate down. And some people are choosing to do that, and some people are like, no, I'll take the higher rate and I'll refinance later. So,
yep, totally depends on that. And, a lot of that depends on a lot of that plays on what the inventory in the market looks like. And so we've got a really interesting inventory setup right now where, we're still, I guess, technically in what you would consider a little bit of a seller's market. But what we've been discussing is that it's actually very home dependent. So if you run into a house that's maybe above a 600 price point, in a good area, you might have a lot of competition for that house. You might see the seller not willing to pay any closing costs. You might see the price drive up above what the market asking price is. But simultaneously, you're going to have that exist, and you're also going to have the same thing exist where you might have a home sit on the market for 4 months, and the seller might be willing to pay all of your closing costs. And we're seeing those really below the 600K price points from there. And one thing to really hit on is the condo market. The condo market is basically is sitting in a really tough spot right now. It's really, really tough to buy and sell condos. A lot of that has to do with the water damage deductible that's been going on, that Fannie Mae and Freddie Mac still have issues with. Basically, the insurance costs on the building that your condo is in have been driven up too high, and a lot of those are not getting loan qualification. So condos are sitting on the market. So I wouldn't even really advise looking for condos right now, to be honest with you, because I think it's such an interesting and terrible situation.
So explain that to them a little bit better about the condo and the water damage, because a lot of people don't know anything that's going on.
Well, a lot of insurance companies are in a tough financial spot, and so what happened a couple years ago is these insurance companies have gone to these the insurance companies that insure the building that your condo is in have gone to the HOAs and said, hey, our insurance costs are going up, and so that means that your HOA dues are going to go up, or we can give you a deductible increase and keep your payment the same. And what a lot of HOAs do is they're responsible for the homeowners that live in that association. And so what a lot of them have decided to do is to take the deductible increase, which is fair because nobody wants their payment to go up monthly. So when they did that, the deductible limits went above and beyond what Fannie Mae and Freddie Mac say is the highest that they can go on deductible. And the reason they did that is because they don't want their homeowners to they don't want to basically have something come on the secondary market that could be a foreclosing situation if you have a water damage problem. So if you had a water damage issue happen, the deductible sometimes is $15,000, $20,000. Well, that's enough if you own a condo that it could take somebody completely out and put you on foreclosure. So Fannie Mae and Freddie Mac want to stay far away from those high deductibles.
Yeah. So what we're seeing is now the HOAs have got to go back through as they meet with their insurance companies and get that deductible, especially the water piece. That just seems to be the one that's sticking out. Get that deductible back down because it's hurting a lot of people with their ability to sell their condo because their condo won't qualify for Fannie Mae, which means they won't get a good rate. So hopefully that'll get fixed with a lot of these HOAs in the next couple of months. And then the other thing we're seeing is that we look back a year ago, houses were on the market an average of 2.5 months. Now that's up to 4 months. So equilibrium's around 5 or 6 months of inventory. And then if it gets above that, then it switches from a seller's market to a buyer's market. So we're kind of in an equal market.
Yeah.
And so what's happened is a lot of people say, hey, houses have been selling for a lot. Like, let's say you're an investor and you've got a rental house and you're starting to notice that houses are selling for a lot. So you go, man, I'm going to take some money off the table. I'm going to go ahead and sell this house. But you haven't done anything to it in 10, 15, 20 years. And so when you go out there, there's more inventory, but a lot of that inventory is not fresh. It's not been updated. And so you can look at two $500,000 houses and one of them is ready to go and it's clean and it's updated and you're going to get multiple offers and it may sell over asking price. The one next door, they haven't done a darn thing to it. And so it sits on the market longer. Seller's more motivated to move. But you got to be a buyer that's ready to go in and put some money down and do some, put some lipstick on that pig, if you will. So there's a lot of interesting things, dynamics going on in the market. So just know if you go look at a house and it's really nice, there's going to be a lot of people wanting to buy it. And if it's not, you may have more room to negotiate.
One last thing that Hometown Mortgage has the ability to offer that really not many of our competition has the ability to offer is a home style renovation loan. This is a loan program that a lot of first-time home buyers, I try to push on them because it's such a great program. You basically can buy a home that needs the lipstick that you were just talking about, and you can build the cost of renovation into the loan. Closing takes about 35 to 40 days. It's a little bit longer because you got to underwrite what the general contractor has plans to do. But it's a fantastic program. I've used it on dozens.
You got to have the time.
You got to have the time. I've used it a lot.
You got to have a different contractor. You can't be the contractor.
Correct.
Right?
Yep. You got to have a licensed and insured contractor. You got to underwrite the scope and the plans that they plan on doing. And they basically take the total of what the general contractor is going to do and they add it to the loan amount. It's a great loan program. If you find a home that you really need some help on, that's a fantastic thing that we can offer that not many of our competitors can. So thanks, guys, for tuning in, and hope you enjoyed it, and see you next time.
Oh, remember, don't go to Google. Go to us. We're your Google. Just call us. We can help you with anything from a mortgage standpoint. Mamas, don't let your babies be Google.